Let me ask you a question. Are you running a successful business, making strong revenue, and yet when tax season comes around, you feel like you're bleeding cash to the IRS? You're not alone. Like many of you, I am a business owner. One of the biggest mistakes I see is business owners assume that as long as they're filing correctly and not making mistakes, they've done all they can to reduce their tax bill. But that's rarely true. In fact, one of the most common ways business owners lose wealth is not through bad investments, slow growth, or even market downturns. It's by overpaying taxes year after year because they didn't build a proactive tax strategy. Here's the reality. The tax code isn't just a list of obligations, it's a blueprint. A blueprint for where the government wants you to build, invest, and operate. And if you know how to navigate that blueprint, you can legally reduce your tax liability without cutting corners or taking unnecessary risks. Today we're going to talk about what that actually looks like. Hi, if you're new here, I'm Glasgow, founder of Glasgow Investment Solutions. For over 2 decades, I've worked with business owners, high net worth individuals, and real estate investors to build strategies that align tax planning with long-term wealth building. This video is your 2025 guide to reducing your tax burden legally, so you can reinvest in your business, protect your personal finances, and move toward financial freedom with intention. Let's get into it. Start with the right mindset. Tax planning is not something you do in April. It's something you build into your overall business and financial structure in year round. The business owners who consistently reduce their tax burden don't wait for their CPA to find deductions. They build a forward-looking plan in coordination with an advisor, CPA, and legal team. The goal? Align your tax strategy with your business goals. That's achieve the system, but you use the system as it was written. Strategy number 1. Understand the difference between tax preparation and tax planning. This is where most business owners make their first and most costly mistake. They assume that handing in the books over to a CPA in March or April is enough to handle taxes. But that's tax preparation, and while it's necessary, it's not where the real savings happen. Tax preparation is reactive. You're reporting what already happened. Tax planning is proactive. You're structuring your finances throughout the year to reduce what you owe in the first place. The difference is critical. Let's say you wait until tax season and ask, what can I deduct? By that point, the best answer a CPA can give you is not much. You should have done X, Y, and Z last year. But if you have a forward-looking plan, one that integrated your business income, entity structure, investment strategy, and even your exit goals, you could have legally reduced your tax liability before the year ended. Tax planning might include the following: choosing the optimal entity structure for your business, S-Corp, LLC, or C-Corp. Strategically timing income and expenses to reduce your taxable income. Leveraging Section 179 or bonus depreciation to write off equipment or capital purchases. Planning for retirement contributions to reduce your AGI and build long-term wealth. Coordinating personal and business finances to maximize deductions across the board. For clients with growing businesses, real estate investments, or multi-state income, this planning also includes investment selection, 1031 exchanges, qualified opportunity zone, oil and gas program, and insurance and estate planning to reduce both income and legacy taxes. The key takeaway here: don't settle for a once-a-year tax conversation. Build a strategy that treats taxes like an active part of your wealth plan, not just a reporting requirement. Strategy number 2, choose the right business entity and revisit it as you grow. Your business structure plays a massive role in how much you pay in taxes, but most owners either set it once and forget it or never understood their options to begin with. Here's a quick breakdown of the various business entities. Number 1 is sole proprietorship. It's the simplest structure, but you pay full self-employment tax and you miss out on advanced tax saving opportunities. An LLC provides legal protection, but by default is taxed like a sole proprietorship unless you make an S-Corp election. An S-Corp can reduce your self-employment tax burden because part of your income is classified as a distribution, not subject to payroll tax. And finally, a C-Corp may be beneficial in very specific cases, like retaining profits within the company, but it comes with double taxation if you don't plan properly. Here's where it gets most interesting. High-earning business owners could benefit from electing S-Corp status, but only if it's paired with smart planning. You must consider the following: paying yourself a reasonable salary to meet IRS guidelines, taking additional profits as distributions, which are not subject to self-employment tax, using accounting plans to reimburse personal expense tied to the business, contributing to retirement plans through business for pre-tax growth. But it's not just about the entity itself, it's about when you revisit the structure. A business making $8,000 might not benefit from the same structure as a business making $800,000. As you grow, add partners, or build an exit plan, your tax strategy has to evolve too. One of the best parts of my job is helping business owners celebrate and restructure a key milestone. Some of these include reaching consistent 6- or 7-figure profitability, selling or exiting a business, adding real estate or passive income streams into the mix, setting up long-term succession or estate plan. Your entity structure isn't just a box to check, it's a tax lever, and pulling the right one can mean tens or hundreds of thousands of dollars in potential tax savings over time. Strategy 3, use the health savings account. If you have a high deductible health plan, then HSA can be one of the most tax-efficient accounts available. This is because contributions are tax deductible, growth is tax-free, withdrawals for medical expenses are tax-free. This is one of the only triple tax advantage tools available in tax code, and it often goes underutilized by business owners. Strategy 4. Shift income to family members, but be careful. If you have teenagers or adult children helping in the business, consider paying them a reasonable wage for the work they do. As long as they're doing legitimate work, this can have the following benefits. Move income into a lower tax bracket, reduce your own taxable income, and help your children start building retirement savings early. Just make sure they're actually doing the work, you're following labor laws, and you're documenting a payment. Also, you're still responsible for employment taxes if valid. Strategy number 5. Real estate depreciation. This gets fairly advanced and where we connect to my expertise. If you own your commercial property or use real estate as part of your investment or business portfolio, you may be eligible for the following. Depreciation deductions, bonus depreciation through 2026, cost segregation settings to accelerate writing. And if you're selling depreciated real estate, a 1031 exchange utilizing Delaware Statutory Trust or DSTs may help you defer capital gains and depreciation recapture indefinitely. This is a key area where smart tax planning and investment strategy overlap. Strategy number 6, deduct legitimate business expenses. You already know you can deduct things like equipment, software, and travel, but here are some often overlooked deductions to review with your CPA. Home office deduction, if eligible. Business use vehicle depreciation. Meals with clients up to 50%. Professional development, coaching, or industry events. Software subscriptions, cybersecurity, and cloud storage. Marketing and personal branding, if business related. Again, the key is documentation and alignment with IRS rules. But when done right, these deductions can materially reduce your tax liability. Strategy number 7, work with a team, not just a tax preparer. Many business owners use a tax preparer, but what they really need is proactive tax planning. That means a financial advisor who understands their business income and long-term goals. A CPA who's not just reactive, not just a tax preparer, but actually embraces planning and the team approach. And finally, a legal partner, especially for succession or entity structure work. Proactive planning reviewed quarterly or semi-annually creates the biggest wins. Tax planning is one of the most powerful tools available to business owners, and it's not about finding loopholes. It's about being strategic, intentional, and consistent with what's already available to you. If you've been growing your business, increasing your income, and want to protect more of what you built, I invite you to book a time with me using the link in the description below. We'll walk through your situation and build a coordinated strategy that aligns tax planning with long-term financial growth. Let's make your hard work harder for you.